Multi-Timeframe Analysis (MTFA) using a combination of the 20, 50, 100, and 200 Simple Moving Averages (SMA) is a powerful method for aligning short-term execution with long-term market bias. By observing these averages across different intervals, such as the daily, 4-hour, and 1-hour charts, traders can filter out market noise and identify high-probability confluence zones where multiple trends align. Roles of specific SMAs in MTFA. 20 SMA represents the short-term trend. It is highly responsive to immediate price action and is often used by day traders or for precise entry and exit timing. 50 SMA acts as the intermediate-term trend indicator. It is frequently used by swing traders to identify healthy trend pullbacks and potential support or resistance levels. 100 SMA provides a broader medium to long-term perspective, often serving as a secondary filter for trend strength between the faster 50 and slower 200 averages. 200 SMA, the definitive long-term trend anchor. It is widely monitored by institutional algorithms and banks, making its levels highly psychological tripwires from major market shifts. Advantages. Enhanced trend confirmation. You can verify that a short-term move captured by the 20 SMA aligns with the primary institutional trend, 200 SMA, significantly increasing the probability of a successful trade. Reduced false signals. MTFA helps filter out whipsaws in choppy markets. For example, a 20 SMA crossover on a 15-minute chart might be ignored if the price remains below the 200 SMA on the daily chart. Precise entry-exit. Traders can use the higher time frame, e.g. daily 4H, with 100 or 200 SMAs to establish a directional bias, and then zoom into a lower time frame, e.g. 1H 15N, using the 20 SMA to find a more refined entry point. Institutional alignment. Because large institutions hard-code the 50 and 200 SMAs into their systems, trading based on these levels allows you to move with major market liquidity. Disadvantages. Lagging nature. All SMAs are based on historical data, meaning they react to price moves rather than predicting them. This lag can lead to late entries, especially when using shorter period averages during rapid reversals. Analysis paralysis. Monitoring 4 different SMAs across multiple timeframes can lead to conflicting signals. For instance, the 20 SMA might signal a buy on the 1-hour chart while the 200 SMA signals a sell on the daily chart, causing indecision. Cluttered charts. Applying multiple moving averages across several timeframes can make charts difficult to read, potentially obscuring critical price action patterns or other key support levels. Ineffectiveness in sideways markets. SMAs excel in trending conditions, but often provide multiple false crossover signals during consolidation or range-bound markets, leading to frequent small losses.